Hey, everyone, and welcome to another episode of the ProVenture Podcast, the show where we talk about real estate, business, and everything in between. And today we have Luca Paoli, who is a dealing representative for Parvis. And he's agreed to come onto the show and to explain to us a little bit about who he is and what he does to help his clients. So, Luca, thanks for sitting down with me today.
Thanks for the opportunity, Giancarlo. It's my first podcast. Very much looking forward to it. Hopefully people find it interesting. And I think this is something that's not super well known in Quebec. And I think a lot of people don't even know that these opportunities exist. And so I'm really happy to get the opportunity to share that a little bit with everyone today.
Yeah, I know. Like we're both from Montreal, Quebec, and you know, like when we met and when we were speaking, you were telling me a little bit about what you were doing, and the first thing I said was like, this is not well known in Quebec, you know, like in my head, because it's something that we see across Canada, across the US. Quebec, it's a little bit of a foreign, you know, practice, but I mean, take us, you know, break us down, like let us know exactly what it is you do as a dealings representative.
Yeah, so essentially I sell anything that's private funds. So it could be either development deals for development projects, either on a condo development, can be a hotel development, could be also for just rentals. And then we also sell private funds. So we do a lot of basically anything that is what they offer through an offering memorandum. We call it OM. So when you have a publicly traded stock, you have to file a prospectus, and then you're on the big board, either on the NASDAQ, the TSX, or whatnot. This here is all uncorrelated to public market. So it's all private stuff through an offering memorandum. So there is still a certain verification that's done. For example, we're governed by the PCMA, so the Private Capital Market Association. I have a license with l'AMF to sell these products. So there is still there's certain encadrement behind it. But yeah, so anything that's private is what I sell. And this is something, like we said, it's not very well known in Quebec. A lot of these funds have head offices in Toronto and, you know, quite frankly, don't even translate some of the documents sometimes in French. So we're just a little bit behind. And ultimately, just in general, these type of products weren't even offered on the retail side till recently. So a lot of these products were reserved for, you know, family offices, pension funds, had high minimums just to get access to these type of products. And with the technology we have today and Parvis's platform and, you know, everything being electronic, so we're able to sign, the barrier to entry, especially with Parvis, is much lower. So we're allowed to go more on the retail side and offer a smaller minimum investment than what was previously, like I said, to family offices and pension funds, just because now the technology allows it. So we don't have to run around and chase subscription documents, and so everything is done much easier. I'm sure you see a little bit on your practice as well in real estate with offers where everything's e-signature now. So it allows quicker compliance, quicker conformity. And so that's why we're able to also offer it on the retail side.
And I will just touch upon everything being digital is that it's easier to organize too. Instead of having, you know, like especially in the residential sector, if there's like 4 or 5 offers back and forth, you know, and then having 4 or 5 different offers and counter offers all documented and everything, you know, electronically, it's way easier. So like moving on, like explain to us exactly like what funds are, what private funds are, how it ties into you know, real estate and assets, and for our listeners who don't know, what's the approach of this investment vehicle?
Absolutely. So I guess I'll start off by just explaining kind of the big lines of what a REIT is. So it's pretty straightforward. Honestly, it's a portfolio of assets. Often, especially at Parvis, it's multifamily assets. Now, there's some that specialize just in industrial or just in commercial, but essentially they regroup all these assets together. So on a smaller side, I'd say our smallest one is maybe around 200 million up to 8 billion, some of the larger ones. And so they regroup it all together. They create a fund and they open it to investors who can come in and purchase essentially shares of the fund. And what it comes down to is they have shares of also the building. And so these funds, by law, actually, REITs have to give 90% of their profits out to as distribution to investors. So they're not allowed to keep any of the money. All the rents that they get monthly are redistributed. A lot of times as a return on capital, so it's a capital gain as well when we sell the position. But so yeah, they regroup all these assets. call it open-ended fund, allow investors to come in often on a monthly basis and take part and take ownership in these big buildings. So a lot of times it's, more institutional sized buildings. We'll see styles like condo style developments where they have amenities. Some of them have even pools and gym, concierge service. And so these are, maybe over $100 million assets that they'll regroup all of these investors together and essentially raise capital to keep the acquisitions going, management going. And so people who are investing in these funds, rather than sometimes they'll question themselves, well, should I buy a fund or buy a hard asset? Well, in these especially in the both from Montreal, we know that they're selling at very high multiples right now. Well,
Yeah.
there's an economy of scale, right? So a
Yeah.
lot of these funds are well established, well diversified. So the risk level is much lower than buying in a single province or single asset. You're spreading your risk in every province. Some of these funds are diversified in every province. Some of them are just only in a couple. But so you're essentially spreading your risk geographically. And then on the economy of scale, well, these funds have professionals managing the assets. Some of them have 300-400 employees in there. And so, they're already investing into something that's established, that's up and going, that's cash flowing. And
Yeah.
then within different REITs, well, they have different strategies. Some of them will have more of a value add where they're going to buy some older assets, fix them up, renovate it, put the rents up to date. And that's their strategies. Other have more of a institutional assets where it's stabilized assets, brand new sometimes, and it's more of an equity play. And so different REITs bring in different risk levels with different strategies, really.
Now, for the listener who may not know, tell us what a REIT is.
So yeah, a REIT is a real estate investment trust. Actually, I kept using. Thanks for the little. Yeah, so REITs. Yeah, real estate investment trust. Commonly in French, you call it FPE, Fonds
Yeah.
Placement Immobilier, and so yeah, so like I mentioned before, these are offered through an offering memorandum. Which, if ever anybody listening is interested, we give them access to basically the investment thesis of the fund, who's taking charge, taking the decisions, what's in there in terms of assets, what's their debt, all those details, the financial statement. So everything's super transparent. A lot of people think that because they're private, they're not allowed to get that information. We believe in giving them all access to all the information needed, and everything's super transparent.
And these assets, like basically these funds, when you invest in assets, where are these assets located across Canada, across North America? Like, tell us a little bit about maybe a little bit of everywhere. Where
Yeah,
exactly are the
all
assets
depending
located?
on the REIT and the size of the REIT. We have some that are diversified in every province in Canada, just like we have some that are only in Ontario, for example, because that's where they operate. That's they're
Yeah.
specialized in. We have some even that have U.S. exposure. So we have, for example, a REIT on our platform that has about 15% assets in the U.S. and it's a way to diversify as well. Diversify in terms of the whole asset class being spread out in case one market doesn't do as well, or one market might be performing much better than others. But mostly Canadian. Out west is very popular. There's no rent control, so we'll see a lot of REITs
Right.
with a lot of properties in Alberta and Saskatchewan and out west out there. Yeah.
Yeah. Yeah. I imagine no rent control is makes it easier for investments to operate and execute strategies and plans,
Very
value.
appealing for them. Yeah.
Very appealing, for sure, for sure. So what's the typical size of like a fund that you work with?
You know what? Our smallest fund is right around 200 million, and our largest is, I would say, is right around 8 billion. So really everything in between. I mean,
Okay.
really depends how diversified they are geographically. A lot of times, bigger they are, more diversified they are.
Yeah.
Honestly, sometimes it's not so much how much A they have asset under management. It's also what their loan to value is. So that's another key metric that I look at before recommending a certain REIT. I'm looking at anywhere 65, 75% loan to value is something, what carries a little bit less risk than some funds that are super high leverage. And if ever there's a liquidity issue, well, you want to make sure that your investment is safe. And yeah, 65, 75% loan to values. So yeah, the AUM doesn't always
Yeah.
doesn't always give it justice.
Yeah. But now, you just mentioned like your smallest fund being 200 million, largest one being in the billions. I mean, I would imagine this is a regulated business naturally, right? Like you're not just taking, let's just say $500,000 or $1 million from an accredited investor. There must be some sort of regulation behind it, some sort of process. Can you walk us through what
Absolutely.
that might look like?
Absolutely. So we have internally at Parvis, we have our own compliance department that they'll review the fund itself or the development project itself, and they have to have some kind of history of success. So we don't have anybody who's new or hasn't proven themselves. We're very, very selective on who we have on our shelf, and they're all the funds that we have on our platform all have audited financials, all reviewed also, like I said, by the PCMA, by the Private Capital Market Association that governs this. And at the end of the day, the IMF, they're there to review and make sure that all of these investments are sound. But at the end of the day, we are the ones making the decision as to what's on our shelf and what's not. So it's very important that we're super rigorous on their history, on what they've done in the past, their success rate, and where they're going moving forward. But yeah, very very regimented, and if you don't have audited financials, even if they're expired, they'll be taken off the shelf, reviewed, and put back on. So they're super strict on that.
Okay. And what do these like when you're working or approaching, for example, a new investor, trying to, I don't want to say convince him, but, trying to inform him on your fund? What are the things that you look for in an accredited investor? And then the second part of that question, what are some of the things that investors look for in you and your team before investing with you?
That's a great question. Honestly, it's more of I'd say the initial contact with investors more just
Right.
asking tons of questions. I'm sure you do the same as well when you're meeting clients or investors, and ultimately you want to figure out what they're looking for and what resonates with them. I have clients that are really asset based. They're looking at the assets, what's in there. They don't really care necessarily as to the size of the product, but more asset based. And I have other investors that are very much risk averse and want something with low to no risk. So we talked a lot about REITs, but we do, as I mentioned a little bit, development projects, and then we do also have on our shelf MIGs, so mortgage investment corporations. Essentially, those are just to make a little sidebar, maybe just give a little parenthèse as to what are MIGs, but so they're mortgage investment corporations. Generally speaking, they're anywhere between 60 to 80 million in first, second rank mortgage debt, and often it's people who can't get financed conventionally. Either they're self-employed, maybe they just changed jobs. Everybody has their own story,
Yeah.
but they'll go see a private lender, and these private lenders will give them a, generally speaking, 65% loan to value on their property. And so we classify it as fixed income. It's fairly straightforward private lending. They know how much they're going to make, what the risk tolerances are, and so very predictable on the income side. So someone who's looking for no risk, or I shouldn't say low risk, maybe more like low risk, that's something maybe I can suggest them more towards a product like that. And someone who's for the longer term, knows that these are investments at the end of the day that are they're not something we're going to put in this month and pull out next month, like some
Right.
coin or something like that. Real estate at the end of the day, it is long term.
Yeah.
Some of these products also, one thing to mention is they do have sometimes lock-in periods, so we'll call them soft lockups, where you'll be a penalty if you pull your position
Exactly.
earlier. Yeah. And that really guarantees also the integrity of the fund, right? So if they're getting new equity coming in, they know that that's going to be locked in for, generally speaking, 2 to 3 years, depending on
Right.
and then that reassures them for future acquisitions. Saying, okay, we got money in the pipeline, and it gives a certain cash flow to the fund. But yeah, just to circle back, and ultimately the question is, what is the client looking for? Is he looking for distribution, cash flow every month? He wants a dividend. Is he looking for more of a long-term play? Or is he even looking for sometimes tax deduction? We have funds that offer tax deductions on flow-through expenses. So any expenses that they'll put in the building, they'll flow it through at the investor. And some of my clients are, saving 3 to 5% a year on their income tax, thanks to these flow-through shares. So it really depends their risk level tolerance and what they're looking for in terms of return.
Okay. And then so what type of investors are these? You know, are they doctors and lawyers that want to put some money in, real estate, but don't necessarily want to manage a hard asset? Are they passive investors? Surgeons? Like, what type of people do you deal with on a day-to-day basis?
I would love to get more surgeons, honestly. They're pretty common.
Yeah.
They have high income and they don't want
Yeah.
you hit the nail right on the head. You know what? It's really two separate sets of investors that I have. And I think that a lot of people have in our industry. So they have, like you said, the high network individual, professionals. They have, maybe a high income, but don't have time to manage a building. Maybe they just also want to diversify their portfolio. Ultimately, since there's no correlation to the public markets, this is something that diminishes your volatility. So they're evaluated either on monthly or quarterly basis. So it's a steady, slowly up and up
Growth.
on
Yeah.
their growth. Exactly. So, and, they don't want to manage the tenants. They don't want to manage a hard asset. So that's something that could be up their alley, diversify, get real estate exposure, and also the fiscal benefits from owning real estate. Those are one type of profile. And then I have more on the, I'd say, retail side, someone that maybe has, 100, 200,000 in liquidity, realizes that buying a building is going to be extremely difficult with the high cash down that they got to put, and then their return is not always there. And then they'll say, well, you know what? I'd rather put maybe 5, 10, 25,000 in a fund and take advantage, like I said before, with the economy of scale of these funds.
Yeah.
Well, they're making, anywhere from 12 to 18%, let's say, on a conservative portfolio with only 5 to 25,000, which you won't be able to do buying a duplex or a threeplex. I know, Giancarlo, you're an amazing broker. You can find us some good deals, but yeah, I don't think you can get in with 25,000. If
No,
you do, then you
not
got
anymore. Not
no,
anymore.
no,
Yeah.
not in Montreal, anyways.
Not in Montreal. Not in the last 10 years, I think, even.
Yeah, yeah. So it's really those two types: either high net worth, doesn't want to manage but wants real estate exposure, or a little bit smaller investor and wants to not put his eggs all in one basket and all into one property. And then also, if there's an issue with that property, well, that's your only one.
Yeah. Yeah.
You're stuck with it,
Yeah.
But yeah, so those are really the two main types, I'd say.
Amazing. Amazing. Now, how did you like get into this business? Like, what were you doing before all this?
You know what? I was actually like he was a old real estate broker,
Yeah.
and spent a couple of years doing that, and loved it. Was always been passionate about real estate, and then I got approached from actually Centurion, which is one of the REITs that we have. It's the largest private REIT actually in Canada, and they approached me to be an associate director for Quebec. So I was selling the fund to wealth advisors. So I could take on any direct clients like I am today, but I was approaching any advisor at the big banks, so BMO, National. We were approved at most institutions, and trying to sell them the idea of why real estate is resilient in a portfolio, and and ultimately, even for some of these advisors doing, because this is what we call alternatives, and alternatives could be commodities or gold and silver, it could be all kinds of things, but essentially anything that's uncorrelated, we'll call it alternatives, and trying to explain to these advisors the benefit of having alternatives in their portfolio and why they should do Centurion. And so that's how I got started. I love the product. I love the benefits that it would bring to investors. And slowly but surely, talking to friends, they were all like, "Oh, this is a great product. Luca, sell me some. I want some Centurion." And I couldn't. So I said, "You know what? Time to go on my own and bring in clients and build my own book." And so Parvis approached me, and it was a fit right away. I love their platform and our website. And I'll encourage everyone to scroll through. You can literally window shop the different funds and the different opportunities on our website. And that's really what spoke to me. And yeah, the rest is pretty much history. And here I am today. A couple of it's been, say, 3 years in the alternative space, and about a year at Parvis now.
Okay, amazing, amazing. And like when it comes to like the future of funds, do you see any sort of like evolution in the way they will operate, or do you think like this system will be, seamless for the next 10, 15 years? Or do you think like for example, some businesses are always changing, always, not evolving, but keeping up with times and trends and, new things? Do you see this as something that, might have to not pivot, but evolve in a certain way? Or do you see this investment model staying the way it is for the years to come?
You know what I could say on that is I think because there's really two sides to it. There's the asset management side where you have to be there in the day to day managing the building. And then there's the whole investment procedure in the back end of that, right? So where I see there's going to be a pivot, and that's really going to be on the technology side. And again, that's why Parvis really was at the forefront of this is as an investment vehicle, if you're not using technology for the subscription documents, for presentations, for any information that's directly to the client, you're gonna fall behind. You need that technology. You need to be in the forefront of it, and needs to be clear. There's a lot of little nuances between funds, between products, the structure of it, and if you're not able to deliver that in a clear way to the client, I think you're gonna be behind the ball. But on the asset management side, honestly, I don't, yeah, there's always going to be technology, whether it's applications or AI and stuff like that to optimize. But at the end of the day, you're managing people and you're managing also hard assets where some of them are in there renovating. And so I don't think not yet, there's no AI construction
Yeah.
worker coming up. Yeah, I know we see sometimes on Facebook, there's robots out there doing some construction work, but I think on the hard asset side, that's still going to stay for the next coming years. But if you want to be, a private equity firm or you want to raise capital, you really need to have something that's different, that's clear. And I think we really hit the nail on the head here at Parvis on our website. Definitely, everything's there, everything's super clear.
Amazing. Now, when you're investing a fund in an asset, typically how big is this asset? What's the range that you guys look for? Is it buildings with minimum 20 units, minimum 100? Like, what does that look like in the terms of the hard asset side?
So a lot of times, I'd have to ask compliance to really see what criteria they're looking at specific on the asset side. But we're looking for an investment thesis that it holds. So we have REITs that have only institutional sized assets. Like I mentioned, kind of those condo looking assets where there's
Yeah.
amenities, but they're rentals. We see that more and more also around
Yeah.
Montreal.
They're doing that a lot now, build condo projects being built.
Yeah. Condo locatif, that's what they call it.
Yeah, I'm actually working with a developer now who's building their first. They've been in business development for 30 years almost, but they're building their first 600 unit rental community. Yeah. And so it's for them, it's a whole new game. They were used to building the assets and then selling them off, right? Traditional. Now I think that, they realize that, especially in Montreal, the rental market, the way it became and everything. So they're working on building their first like 600 unit or 570 unit, condo rental community. And like this building's amazing, 15 stories, gym, theater room, game room, terrace, pool, the whole thing, right?
Yeah.
So awesome. Now, let me ask you this. When you are putting a fund together, because there's essentially two parts of this business, right? The fund and then the hard asset or the acquisitions part, right? Like it's great to have a fund and to say we have $200 million to invest, but then you need something to invest in asset wise, right? Is that a whole different department that goes out there and acts as like headhunters to purchase, these
Well, a lot of these
buildings?
funds, just to make it, we have about 50 to 60 different products on our shelf, right? And
Okay.
each one will have their own acquisition strategy.
Okay.
A lot of them, if it's a big asset, they'll even be approached from either if it's an owner or it's another REIT or maybe it's a family office or even just an institutional pension fund. There's some pension funds out there that own buildings themselves. Very few, but there is. And they'll say, all right, well, we want to sell it. And they'll go and speak to the bigger REITs out there and they'll talk amongst themselves. And a lot of times it's done behind closed doors. And just like we have REITs on our platform that will even do some lending on development projects and give them some first rank of purchase. So actually, that was something at Centurion that they did quite well. They would essentially fund part of the development cost for a rental project. So kind of like that 570 units there, they'll be financed maybe 40-50% of the project, and they'll give themselves first rank of purchase. So once it's completed, it's an acquisition strategy for them. They get first pick. They want the asset, they make an offer, and if not, well, it goes on to somebody else. But it's really important to see what's coming up in the pipeline. So a lot of these funds will even say outright, well, look, we have, the 200, 300, 400 million in future acquisitions. Here's the penny. And here's the thing too, is that they take quite a long time to close on these deals. So especially the bigger deals, I'm sure you've seen somewhere that, you're working on the file for 6 months from accepted offer before you see the notary, and 6 months is probably even short. Some of them could take even longer. So you're working on with a certain pipeline. You know that, all right, in the next year, we're going to have X amount of new acquisition. And then that also that brings up the unit price on the fund. Right? So it's
Right.
nice to see when they have a nice cushion of acquisitions coming up, and you're like, all right, it's a good time to come in. Hopefully the NAV, net asset value price increases. And so, yeah, so we do see quite a bit of new acquisitions on certain funds coming up in the future. So it's an exciting time for that.
Yeah, no, like I would imagine the bigger the deal, the longer it might take.
Yeah,
You know what I mean? I would imagine, especially on the hard asset side, if you're purchasing a 200 unit building, 300 unit building, there's tons of like due diligence to do. You know what I mean? Before locking in a deal and locking in a fund on that asset. You know what I mean? Or even before putting it on your shelf, right? It must meet certain criteria, I would imagine.
absolutely. Yeah. Well, the good thing is that a lot of our open-ended REITs, they're fairly stabilized, fairly, I don't want to say the same kind of assets, but their acquisitions will look like similar assets that they have in the portfolio. So they're open-ended, they're on our platform all the time. Some development deals, well, when they raise the amount of equity needed for a lot of times the construction cost, they'll do a raise. Let's say, for example, well, we're going to raise 3 million to build 50 rental units. This is what it is. Well, when they raise that equity, that 3 million, while the fund is closed, everybody's money gets invested, and then we pass on to another project. So the REITs, the stabilized REITs, pretty much on our shelf all the time. And the development projects, well, that's, yeah, where you see there's going to be an approval process, and that takes a little bit longer as well.
Amazing. Amazing. So, I mean, like, if anyone is listening and they want to be, and they're an accredited investor or they're maybe a surgeon, you know what I mean? And they're thinking of, this type of investment vehicle, what would be the best way for them to like reach out to you, to get in touch, like, or anything that they could do to maybe set up a call, a meeting, or anything like that?
Yeah, absolutely. They can reach out either by email. I don't know. Are you gonna leave an
Yeah, we
email?
could
Yeah.
drop your coordinates in this. Yeah,
Yeah,
we could
so
drop
they
your
could
coordinates.
call me 514-772-1913, or they could send me an email or LinkedIn, type in my name, Luca Paoli, or Giancarlo's got my information too. Ask Giancarlo, and we can go for a coffee and chat. And ultimately, I have a really easy approach. I think that's why you and I hit it off. I think we have that in common. Is
Yeah.
we're not pressuring people. It's not a high pressure, high pitch sell. It's like, hey, look, a lot of these people, like we said in the beginning, don't even know exists. So it's like, hey, we're here when the time is right, and the person, feels comfortable and says, all right, can't find a deal. Giancarlo helped me. I can't find nothing. Let me step in and see if I can take part of a big project. So yeah. Any way, phone, email, I'm always available.
Amazing. No, look, if there's a listener out there who is in the private equity space or, basically looking to do what you do, what are like the three pieces of advice that you could offer a young aspiring businessman who might want to be, working with REITs, private funds, and in a similar field?
You know what? I this is even for myself too, not just for newcomers, but I'd say, not first of all, they have to have a really good understanding of the fiscal aspect. I'd say that would be the biggest thing. And that's something that I even recently I've had to kind of, to spend some time and study a little bit the fiscal advantages of these products. So there's some of them that are giving, like I mentioned before, they're giving a tax deduction versus on your income, right? So they're giving flow through share. So that's something to get familiar with as to, especially those high network individuals, being able to explain to them why it's beneficial for them and what it does at the end of the day. What's the tax slip? So, they call it T1031. They have a 50. So there's a lot of, complex nuances there. And so that's say number one, get familiar with the fiscal implications of these funds. And I'd say two, if you're able to offer, like, I got really good real estate base, but you have to be able to explain the benefits of these assets, right? And being able to explain also like how do these funds even manage the day to day. So now we're keeping it kind of high level, but I mean there's funds out there that register how long a tenant is on hold for. So I
Right.
mean they're
Right.
going really super detailed. The how many toilets are being flushed? Can we diminish the water usage? I mean some of these are really really detailed in, and so I really are our systems that we have in place and our website. If you
Yeah.
have good either cold call or cold email, everybody's got their own little or networking or you got to get out there, you got to get some FaceTime and meet investors and network a bit. But yeah, that would be the fiscal, the asset management side, and then you got to get out there and spread the word.
Yeah. I mean, I'm pretty sure for someone getting into the private equity space, approaching their first $100 million client or $1 million client, if they never did it before, it must be something, it must be very, very rewarding when you land that client. You know what I mean? And
Yeah, it's
everything.
always a little nerve-wracking at the beginning.
Yeah.
All these guys, and this is I tell
Yeah.
people, especially the newcomers, they're a little bit shy. There's this guy's worth a lot of money, and they get a little nervous. But we're all pretty straightforward guys. At the end of the day, some of the high net worth individuals that I got the chance to meet are some of the nicest people out there, and so
Yeah.
don't be shy. Shake their hand. There's no one who's winning will look down on you. I really believe
That's
that if
true.
you're, you ever heard like a successful musician saying, "Oh, you're bad at this," right? Like they'll always
Yeah.
try to uplift you. And so it's the same thing for investors. They may try to get you on a couple of questions, but they're all a lot of the investors. I got the chat. I got maybe lucky though, but they were all super nice and love to meet more of those surgeons. If any surgeons are
Yeah.
listening, you
Yeah.
guys are cool. Give us a call. Yeah.
Yeah, I'm saying that 'cause how one of my management clients is he's a cancer surgeon, and he invested in a triplex, and he thought, real estate was the way to go. But when he invested in a triplex, he quickly realized, like, I don't have time to manage a hard asset, so. Which is why I refer to surgeons, because I know how busy they are, and you get called for a surgery, you don't have time to get called from a tenant to, for plumbing for a toilet type of things.
Yeah, no,
Yeah.
absolutely. And a lot of times that's what it is. You're managing tenants, you're managing provs. Not all the time, sometimes
No.
there's periods it goes well, but
Yeah.
it really depends. If you're an active investor and you're young and you got the time, I don't
Right.
think it's necessarily a bad thing. If you see a deal on the market and you think there's potential and you're ready to put in kind of maybe sweat equity a little bit and get in there, I think still a great option. But for anybody who wants more of a hands-off approach, and maybe they're just also looking to make a certain return, a duplex or threeplex, depending on how like we said before, the high multiples that they're selling at, they have to put 2, 3, 400,000 cash down, and their return on investment's not always there right away. And so that's an issue for some investors. At the end of the day, they want that return.
For sure. Well, I mean, man, thanks for sitting down with me today. That was an awesome, informative episode. And I appreciate you taking the time to come in. Well, come in to sit down,
For now,
to-
next time we'll do it in
yeah,
person.
next time we could do it physically. But
Absolutely.
thanks again, Luca,
Thanks for
for
the
yeah.
opportunity. I really appreciate it. This was an awesome experience. Really happy we did this.
Awesome, man. And for anyone watching, whether you're watching us on YouTube, Apple Podcast, or Spotify, be sure to hit that like, comment, or subscribe button. Until the next time, guys, we'll see you soon.